Hello and welcome to the Investor Master Series. My name is James Boyd. We welcome you here today. We've got Connie Hill in the chat. We welcome her. Got Don, Ocean Life, Will, AP514, Fayez, and many others. Welcome to all. Now, when we talk about Investor Master Series, we're talking about stocks, options, futures, and Forex. I used to teach on Thursday. We don't teach those. We talk about ETFs on Friday Friday in the morning. Connie talks about ETFs on Monday. Those three topics of futures, Forex, ETFs will not be included in this session. But also remember that anything else goes, which covers a lot of ground. So we'll talk about technical analysis, fundamental analysis, short-term, intermediate, long-term trends, all of it. So the purpose of this class is to kind of bring everything you're learning for the most part and kind of how do you bring it together, okay? Whether you're starting a portfolio, kind of allocation, things like that. So let's go ahead and get started here. Now, remember that options carry a high level of risk, not suitable for all investors. Also, remember when we talk about examples, I'm going to give some information. As we talk about that information, remember it's given for general informational purposes only. This webcast discusses technical analysis. There's other approaches, including fundamental analysis. Ben Watson will teach that class tomorrow. I will be out of the office. Boy, I wish I could be here, but I will not be available. For tomorrow's class, Ben Watson will teach that. Now, also quick reminder that next week, December 24th, we will also open up some technical presence here, paper money presence, together. That will be our last class for this year. Following that, we'll reset the paper money portfolios. Okay, so quick heads up there. Now, remember when we do the paper money account, that is for educational purposes only. Investing involves risk. And also remember when we talk about short options, those can be assigned at any time. These are American options that we're talking about, not European, okay? And also remember, we're going to show examples. They're not recommendations. However, I would ask that as we do examples, go in your paper money account and practice so that when we talk about the management, you say, yeah, I've been looking at that one on my paper money account and I can see it. And I've been watching it, things like that. Again, not a recommendation. But that way you get a real sense of what's going on, okay? And you're following through on it. Now, today, just briefly, the main focus I want to talk about here today is bearish strategies, okay? We talk about bullish strategies a lot, okay? We talk about them a lot. I think it's actually due time that we talk about some bearish strategies in protection. And also kind of, we talked about last Thursday on exiting. Now, if you did not get the last Thursday class, let me share with you this link, okay? I said to you before, this is going to be a class that you probably want to know by heart. I pledge allegiance to the bearish flag of America, okay? We could say it like that. A little fun there, okay? So just remember, if you say, I don't really know what would be exits, potential exits, well, this would be a great place to start. This is the foundation of when we talk about making exit decisions. We're using this as the kind of the criteria. Now, also want to, as we hop right in, want to kind of talk about some different strategies of bearishness and why an investor might use one versus the other. We'll talk about many examples here today. Now, why are we talking about some bearish trades? Well, don't get me wrong. There are some bullish trades out there. But if you look kind of in aggregate, you'll kind of see that there's kind of more bearish examples than bullish examples. Now, briefly, if you look at just the SPX, it's kind of flatlining a little bit. Both, well, when we look at the price is below the 10 and the 20 period moving average. So when you look at the SPX, that's not really what we're looking for. If we're talking about bullish, we want price above the 10 and the 10 and the 20, not below it. Right now, the SPX is showing that. Now, what type of strategy? If you're if you have stocks or bullish option strategies, etc., and you saw that, the investor would probably be thinking about exiting some positions, verifying they don't have any exits, managing risk, and so on. Now, with that kind of said, I want to kind of speak to just a couple quick examples that we have in the paper money portfolio, okay? And I want to start with just real quick. We did over the last couple of weeks, okay, some caller examples. And what is that again? Well, it's buying the stocks, selling the call, and buying the put at the same time, okay? Now, you got to remember that's a bullish strategy. Typically has a delta of about 30 or so. Your risk profile is going to look like as followed. You're going to have a short call to the upside that caps the upside potential, okay? And you're going to see the downside goes flat because, well, we got a long put, the right to sell. This right here is generated because the investor owns the shares of the stock. If you think about a collar done like this, it's about triple the delta, typically, as you would with a short put vertical or a long call vertical. Probably double or triple the delta. Why is that? Well, it's because the investor has the shares. I want to take a look at our positions and just make sure we're not falling asleep at the wheel, okay? I'm going to tell you 1 day matters. 1 hour matters. 10 minutes matters. You want to each day actually be focused on your positions because you're the CEO, you're the CFO. No one else cares, okay? Now, if we take a look at this, what I want to do is I want to just take a quick look at how do we kind of cheat a little bit? How do we cheat to kind of see if we have kind of maybe some gains? Well, all we like to do is kind of look at what do we buy the stock at and then what's the short call. Anyone tell me about approximately what's the upside from 443 to 455? Just approximately. Just, you don't have to give me the exact sense. Would you say it's maybe about $11? Are you okay with that? It's about $11. Now, a lot of the time when we do the call and the put, those are most likely probably going to be closer to zero, okay? So when I go look at this gain right here, okay, I'm going to ask myself, how close are we to the $11? Now, where do we get the $11? Well, we bought the stock at about 443, and we have a cap at 455, okay? Now, it's really, we bought the stock at 443.64, if you want to get technical. We're just saying this upside move in the stock is $11. We're now asking how much of the $11 do we have? We probably have about 40% or so. So if someone said, are we going to profit take today? Do we need to manage the position? The answer is no. We don't need to manage the position. Okay, there's nothing to manage right now. We're not at expiration. We don't have 50+%, 65% of the maximum gain. There's nothing to do here. All we did is cheated. Look at where we bought the stock. Where's the short call? How much stock gain is that? We compared to that, what's the profit loss on that? We got 350 of the 11 so far. Next one. You look at Amazon. What do we buy the stock for? 212. Okay? 212. And what'd you sell the call for? The 220. How many dollars is that? It's $8. Okay? $8. Now, we go over here and we got $570-ish in hand. Now, do you think this one deserves a little bit more inspection? I think it does, okay? So if we look at the stock, the maximum gain on the stock is $8. We got 570 right now. Now we're kind of wondering, geez, if we got 570 divided by $8, what percent do we have? Now, for us, we kind of like to use that little sheet that we've been using the last couple of weeks, just kind of running through the numbers. Let's just kind of run these and see if we could potentially profit take on this. Let's kind of run those numbers, okay? Now remember, we haven't made anything until we actually sell and we get a fill, okay? So I'm going to take that number in, 211.93, and the short call was at 220, okay? So 220. Now, what was the premium? Now, we haven't brought in the premium. This so far from there to there, I said $8. Technically, it's 807, okay? Now, what was the credit received from the call? Answer, 455. So now, if you look at the put, what did we pay? Well, you paid 380. So did we get a net credit? By the way, yeah, Merry Christmas to you as well, Alarian. Okay. If we look at this, do we get a net credit or a debit? Well, that would be a credit. What's the credit? And the answer is 75 cents. So the most we can make on this position, if it were to go to the upside, is 882. Now, if we look at this position and kind of say, well, how much have we made on this so far? It's about $575. Okay. So what percent of the maximum gain do we have? Answer, 65% of the maximum gain. And there's 31 days remaining. Tell me how to manage this now. Now, we kind of knew we could probably look at running the numbers. because we kind of said, what do we buy the stock for? What's the short call? How many dollars is that? And then we looked at kind of how much we were up on the P&L. We said, this one is probably close. The first one, not so much. Now, we always talked about if we could maybe get 50% in the first 10 days, okay, awesome. Investor might take that. 65% with 20 or more days, or 80% ever. Well, we got 65% of the maximum gain, and there's 31 days remaining. So that kind of sounds like we're going to go down that second door. And what we're going to do on this position is we are going to, now, if we want to profit take and not re-enter, okay, we're going to right-click on that, create closing order. The loss is in the options. Where's the gains? Well, the gains are in the stock, okay? We're going to create closing order. We're going to buy that back, okay? We're going to exit those for a debit, and we're going to go confirm send. Note the commission, okay? Cost of trade included commissions. Send the order. Now, we want to make sure that that fills, okay? So now when I go back to this and kind of say, okay, what do we have now? Well, on that, we just have the shares. So how do you sell the shares? Right-click on that line, create closing order, sell, okay? Now, confirm send. Note the cost of trade including the commission, send. So on that trade, it was about $570. Now, if we would have known the future, the investor would have said, well, I would have just bought the shares. But remember, I think a lot of investors, they're kind of nervous to get in. This kind of allows the investor to take a bullish trade, but then have some, I call it like bumpers, okay? If the stock actually goes down, well, let me kind of reverse it. The stock goes down, we got a long put for protection. The stock actually goes to the upside, there's a cap. Don't like the cap, but the cap does help pay for the long put. Are there any questions on this? Now, Wiley says, close, go buy Amber a lobster prime rib dinner. Funny you should mention that. We've got some plans here for Christmas Eve, Christmas, New Year's Eve, and so on. Yes. Now, I've been kind of thinking about taking European vacation. Got 2 tickets to Europe, and, Amber's she's a good woman, so she probably deserves that. All right, a little fun there. Now, now I want to go back, and I want to look at doing one more of these, okay? Now, I think the way you really learn these, now, by the way, let me just double check something, okay? The other one that we have that has also kind of had some pretty good push is you're going to see on this Apple position, okay? And I want to go back to this just real quick. Now, how do we know which one is which? Well, this position on November 15th at 2300 hours, my time, I live in Salt Lake City, you're going to see that this was an old short put position that was assigned. Assigned just means that we bought the shares at 230, and now the stock is at 238. Now, first question to you. Do you have to hold those shares for any length of time? No? We could try to go sell them, okay? Now, we're going to review what the exits are for stock and just hold on to that. But that assignment, now, by the way, that $2,300 does not include the premium from the short put. That's added on top. I know you should feel sorry for this account. But let's say we got $350 or whatever. That's $350 on top of $2,315. Okay? So being assigned is not necessarily always bad. Okay? You can't have a loss too. In this case, it was a gain. Now, what I want to talk about is this one, where it's done on the 9th, 9th, 9th. Now, let's just do the quick math in the head, right? So if we bought the shares at 246, and for example, let's say we agreed to sell the shares for 255, okay? How much upside is that? Well, the upside there from 240, let's just say 247 to 255, $8, okay? Now, when I come and look at this position, do we have, how much of the $8 do we have? We got 635 less about 300-ish. We got about 300 of the $8. I think on that one that we did before, we're about 40% of the maximum gain. So that one's still in the oven, but let's go back. So we don't have anything to do there. And where'd you get the $8? Well, let's just round up to 247. You got an obligation to sell the shares at 255. The difference, $8. What we're doing is we're looking at the position over here and we're saying, how much, if I said 642 less 214 less 131, what do we got? It's about $300. $300 of $800. It's about 40%. So we don't have anything to do on Apple. Now, my question to you, in application of the class that we talked about last week, do we have sell signals on Apple, the stock, right here and now? I want to know. So let me kind of close this up for just a moment, okay? And if I looked at this and said, okay, the trend on Apple is in trend 3. Is that a sell signal? Trend 3. Have I ever talked about that? Sell in trend 3. We ever talked about that? Tell me if we did. Now, if we look at the whole counter, how many days has the 10-period moving average been green on Apple? 28 days. Glorious days. Okay? Now, how long has the 20-period moving average, the whole moving average, been green? Okay? And what you're now going to see, it's been 24 days. So we cannot say that there's sell signals on Apple here. Okay? We're not even in trend 4 yet. Now, are we saying that all stocks are going to go to resistance? No. So what do we need to be prepared for? We need to be prepared that if that stock doesn't go to resistance, we don't get to trend 4, but the price snaps down, that you could go to trend 5 without ever going to trend 4. That happens when the stock doesn't hit a resistance area or a target area and the price snaps down. We do not see that right now. Now, if we said, well, James, I trade on the weekly chart, we don't see it on the weekly chart either. Trend 3 on the weekly, 4 weeks up on the 10 whole, 4 weeks up on the 20 as well. We don't see anything on the daily charts or the weekly charts. Now, whenever we talk about scripts, they're not guaranteed for accuracy or timing. You can verify those to make sure they're showing what you want to show. Not a bad idea. Now, so good job on Apple. I tried to trick you. You guys got it. Okay. Now, what I want to do is I want to go back to one example, and I want to go back to, let me show you what Apple looks like for just a second. Okay. So some of you Apple haters out there, and I know who you are. Okay. Now, I'm not going to add to that position because we already have the shares already. Okay. We have 100 shares plus we have a caller position. Okay. Now, what I do want to bring up is I want to go back to just real quick a couple stocks, and I want to fast fire in a couple, let's say, Dow stocks. Boeing kind of still grinding away a little bit to the upside. Honeywell, okay, kind of had a big flag here, okay? And you'll kind of see this flag might have been in the angle, something like this, and you're going to see right there a big pull, okay, right there. All right. And so there's a decent breakout on that. Now, let's say the investor said, you know, James, I want to buy the shares, but I'm a little nervous about maybe could the breakout fail? Or I'm maybe a little nervous about what the market might do. And then maybe could these investors maybe just sell after the new year and so on and so on. Okay. Now, what I'm going to do is I'm going to go to the trade tab for just a sec, and we're going to fast fire a caller position. Okay. So step 1, we're going to buy the shares of the stock. Step 1. Okay. Now there it is. Not too bad. Buying the shares of the stock. Now remember, if you're going to do the strategy, you think it could go up, of course. Okay. It's positive delta. Step 2, we're going to go down to first triggers SEQ because we want to do the orders in sequence. First, buy the shares. Second, sell the call. Third, buy the put. Okay. Now, how do you sell the call? We're going to go 20 to 50 days to expiration on the monthly options. And then what we're going to do in this case is we're going to sell, okay, the 240. Now, if you sell something, let's say the 250, you have higher upside potential on the shares, on the share price from 234 to 250, but there's a lower premium. And if there's a lower premium, then there's a pretty good chance you're going to have to pay for overall the caller itself. So what we're going to do in this case is we're going to go to the 240. And when I click on that 430, I want to try to get in the middle, like 440. If you're the seller, you're trying to get the higher price. On the put side, we're going to go to the delta 30 to 40 again. Okay. I think we've done about 12 examples now. And the variation has been minimal. We're doing the 20, 50 days to expiration, buying the shares, selling the call with the delta 30, 40, buying the put with the delta 30, 40 over and over and over again. Now, we could talk about variation, but I'm going to kind of keep it steady so you can get some practice. And then what you're now going to see is 340. Now, is there a credit or a debit on that caller? When I say the caller, I'm talking about the short call and the long put in this case. Well, if you collect 440 and you get $1, it's a credit of 340. Now let's punch through these numbers quickly. What are we buying the stock for? $234.99. What's the short call? Short call's at 240. Do we get a credit? It's $1. What do we see? What's the maximum gain? What's the maximum loss to the downside, excluding commissions? Well, if you look at this trade, you have a maximum gain of about $6, and you have a max loss pre-commission of $3.99. Okay. Now, what I kind of think is kind of interesting is when you look at a short put vertical, okay, you might get something like, hey, I got maybe a $2 credit, maybe, and you have a $3 max loss. Okay. If you did, let's say, example given, a long call vertical, okay, you typically are going to get maybe, James, I got a 250 max gain, and I got a 250 max loss. So it's like 1-to-1, okay? Now, let me kind of move that over. Yeah, we'll leave it where it is. You can see it. Let me fix that, though. Don't like that, okay? Yeah, let me move that over. Okay, give it a little bit more room. Okay, so the short put, you don't even get 1-for-1, okay? It's a probability trade. Long call vertical, typically 1-for-1, okay? Notice here in this caller, it's 6-to-4, okay? So if you're trying to stack more of the odds on your side, then if you're right, you can have a higher gain relative to the loss, welcome to the caller. Now, James, why are you so fanatical about the caller in the last 2 weeks? Well, some of the market conditions we've seen have been some of the strongest that I have seen since 1999 when I was 13 years old. I'm just joking. I was 21, okay? And I still remember in 1999 in Provo, Utah, 532 East, 532 North, 300 East. Yes, I still remember staring at, well, my computer back then. There was an almost dial-up connection, thinking, I cannot believe these markets. It's made me remind myself of those times. So I'm not saying that they can't keep going up, but you better believe we want to have an exit plan before things drop. So, by the way, this could be something that you like do a buy right strategy, but it also could be something that you leg into. Meaning, if you have the shares already, then you could just put the collar on. Or, as we've been doing, where if you say, my timing is horrible, I just want to get in all at once, that's what we're showing here, okay? So once you get this down, then you say, look, I'm going to then focus on legging into collars where I become concerned about the stock not breaking through resistance. And then second, the stock has now broken down and I want to protect myself. Now, I'm going to tell you something right now. In 25 years of doing this, I know I've met a lot of people. I'm going to tell you this strategy, I think, is people can talk about bear strategies, but if you really said, no, I'm not talking about if you know about bear strategies. Have you traded these strategies? And all of a sudden, you just hear cricket, 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 cricket. Okay? So one of the things is you can listen to how people talk about it, have they really had experience in trading it? Oh, you can hear it. Okay. Now, the biggest thing is notice that where's the commission coming from? The commission's coming from selling the call and buying the put, but not the shares. Okay. Send the order. Now, I want to talk about for just a moment one other stock that we're going to kind of keep an eye on. Now, one of the things that I've seen lately that has been just bananas. Okay. The move on Tesla lately has been unbelievable. If you've been watching that, keep an eye on, for example, Microsoft. That has been one that broke the upper channel, made a higher low, made another higher low. Can anyone tell us again how we know where the higher lows are? Can anyone tell me? We know where the higher lows are because when you get a higher low, okay, you have a pullback in the price and then the bounce starts with a green candle. pullback in the higher, we make a higher low because we have a pullback in the price, red candle, and the bounce starts with a green candle. Pullback in the price, red candle, the bounce starts with the green candle. Pullback in price, red candle, bounce starts with the green candle. Now you might push back and say, well, James, what if the red candle is a hammer? Okay, maybe then it's the bounce starts with a red candle. But you don't always see the hammer candle being red to boot. Most of these bounces, we want to start to see like a piercing line, maybe like a bullish engulfing, something like a close above the high of the low day candle, and so on. That's a stronger bounce than a hammer that's red, okay, the color of the candle. Now, keep an eye on Microsoft as well. The other one we're going to kind of say keep an eye on from a bullish. Okay. I said we're only going to do one trade on that Honeywell example. I want to go back to just real quick Visa for just a moment. Now, I want to also do this from a stock perspective because I'm imagining. So I want you to imagine when you go to the mall, wherever you shop, and people are just swiping their card, whether it's a credit card, a debit card, who is making a small fraction of that? Every time they swipe, like Zora, okay? Well, these companies like MasterCard, okay, Visa, American Express, the one that's been the most bullish so far is Visa, okay, that we can see. Now, what I'm going to do is I'm going to right-click on this chart. We're going to do a stock trade, okay? We're going to do buy custom with stop. Now, notice there's not any expirations. We don't have any strikes. Stock trade, okay? Now, what we're going to do is we're going to set the stop right below the 20-period moving average. The 20-period moving average is sitting at 313, okay, 50 or so. If we take a stop less 2%, it's going to set us up with a stop of 307.23. So my question is to you now is, how is this stop different than like doing a collar strategy where you have a long put? How's it different? Well, if you just set a stop and we just go down there for a split second, it could trigger to sell and the trade could lock in that loss. And maybe it bounces right back up. If we did the collar strategy and the stock goes down to the long put strike, it does not mean the trade is over. Nothing happened because you had a right to sell, but you didn't sell. Okay? So with a stop, if it goes down to that price or less, it triggers a sell immediately. Okay? You got to see where it fills. Where the long put is just the right to sell, it's not locking in losses. That only happens if you go out there and sell the entire position on the collar. Okay? Now, what I'm going to do is go day to GTC. Now, that's a big misunderstanding. I thought if I buy a put and the stock goes down to long put, it's like a stop. Wrong. That's not true. And that's a big advantage of the long put. Now, what's the bad part about the long put? The long put has an expiration. Okay? That's the big difference there. Now, one of them. Now, if we take a look at this, you're going to see that we're buying the shares of stock, setting a stop, and we're going to see if that trade can bounce to the upside. Now, this stock, if we take a look at this, is kind of sitting right there in a channel, okay? Low end of the channel, top end of the channel. Now, by the way, if we kind of took a little bit off the top, you might kind of say $7. At maybe the widest part, if we kind of took that, you might say $10. So you might put a price target and say, James, if this goes to 327, I'm going to try to take the position down, okay? Now what I'm going to do, okay, is I want to go back to just real quick. Let's kind of look at two bearish examples, okay? Now let me kind of show you a couple stocks that I looked at this morning. They were absolutely, well, let's just say they were very tough, okay? So if you look at a stock like Siri, I mean, hit a fresh new low. Has not even gone up when the market has been this bullish. What does that tell you about the company's stance in terms of kind of getting some portfolio managers to get interested? Not a whole lot of interest. I mean, this is amazing. If you held Sirius stock and you have the stock market go straight up, and Sirius is hitting a 52-week low. Kind of tells you there's something maybe not great going on. AMD almost as well at fresh lows when the S&P or the NASDAQ is at near highs. If you also look at Zscaler, you're going to kind of see that position is kind of right on the fringe of kind of maybe breaching support and maybe trying to go down to the next level and so on, okay? So then when you start taking a look at some of these other stocks like Apache that cratered again to a fresh new low, okay? You're going to see that's hasn't been great. Fresh new low for that. CVS hit another fresh new low and just been a cliff lately. NRG, okay, kind of a recent breakdown, had an upward channel, okay, and we broke down through the channel. Now, wait, if we had like a channel to the upside and broke to the upside, we know the measurement technique. The same applies to if it broke to the downside. So NRG kind of being a fresher one to the downside. We'll come back to that in just a moment. SLB, kind of more of a sideways channel. And you're going to kind of see the measurement technique applies to the upside and downside. Not looking too great for Schlumberger or Berger, okay? And ConocoPhillips, as we mentioned yesterday, just absolutely horrible, okay? So a lot of these energy stocks not liking kind of where crude oil has been and also maybe forecasted where it could go. Now, what I want to do is I want to quickly explain something to you for just a moment, okay? Now, when we talk about bearish strategies, and I'm just going to do this briefly and we're going to do some examples, okay? But I want to kind of get some examples of why would I even care about, let's say, doing bearish strategies? Remember what I said to you yesterday. If you understand bearish strategies, there's a better chance that you're going to be probably better at exits because you know what bearish entries look like. You want to see both sides of the table. You want to see what does it look like if it's bullish, but also you want to have an understanding of what would a bearish investor be looking for to maybe consider an entry. So if you understand bearish entries and strategies, I think you're more apt, okay, to probably have more confidence in exiting bullish trades. Now, the second part of this is sometimes trends are not always bullish. Sometimes the trend goes down. And so when we talk about, let's say, strategies for bearish trades, like I said yesterday, the first main bearish strategy is just a short call vertical, like we did on NVIDIA. The problem with a short call vertical is it only gives you about a delta of maybe 10-ish. I look at a short call vertical as more of a probability trade. Okay. So if that stock goes down, yeah, I might be right some, but I ain't going to be right a ton. Okay. Maybe it feels good to be right, but I guess how much are you right in terms of the gain? Now, if we also did, let's say, a long put, I'm going to kind of bump this to maybe 15 on a long put vertical. Where does someone start, or where could they start? They probably start right in this long put vertical and a short call vertical. And here we're trying to kind of get to more of a profitability trade. Okay, I'll abbreviate that. So why do you do a long put versus a short call? You think there's a greater chance that it could go that direction, and you're trying to make the upside potential higher. Now, what has a higher delta than a vertical? What has a higher delta than a vertical? That'd be pretty simple because we kind of said it so far. It's a long put. Now, if you buy a put, you're probably going to have a delta between maybe 30 to maybe somewhere, let's say 70. Okay. When I say delta 30, that is out of the money. If we said delta of negative 70, that is in the money. Now, wait, why did we say negative delta? Does anybody know why we said negative delta? Well, if we do a bullish trade, positive delta, it's a bullish strategy. If we said negative delta, it's a bearish strategy. Now, if you look over here and say, well, what comes after this? Now, for some of us, this might be maybe the most interesting strategy, okay? But let me go all the way over here to the right, and then we'll fill in the middle, okay? Now, a short stock, okay? A short stock can only be done in a margin account, okay? And you got to pay to borrow it. You do not have an indefinite period of time in which you can borrow it, and you have to pay the dividend if it pays a dividend. So there's a lot of red tape on short stock. Now, that's how I got started. I didn't know anything else, never heard of options. So I would go long stock and short stock. The other risk to short stock is the stock could gap up and the loss is infinite. So, man, you better know what you're doing if you're going to short stock. And even if you know what you're doing, there's still quite a bit of risk there. So I'm going to take short stock off the table. I'm going to just take it off the table. We're going to kind of take something in the middle, a short synthetic. A short synthetic is what we already saw before. It's a short call vertical. And we're going to add an extra piece of bread to the sandwich. Make myself hungry, okay? I have surgery tomorrow, so I'm kind of hungry right now. Okay, short call vertical. Now, by the way, I should be back Thursday. But if I'm not, just remember the 10-day moving average. Okay, short call vertical. It's all about probability. Okay, I already know that. Short call vertical plus a long put. Now, wait, when you do that, that probably means your delta is -50 to -60. So it's a higher negative delta trade, okay? What we're trying to do is play some probability, but we're trying to use the credit from the short call vertical to pay for the put, okay? Now let's do some examples here. Let's practice that short call vertical with a long put. What do we call that? It's a short synthetic, okay? It's not as bearish as shorting stock, but it's pretty close. And it has some benefits of profitability and a bearish directional trade. Let's do two examples, okay? Now, what I'm going to do is let's go back to this. And what I want to do in this case, let's go back to just for a moment APA. I think it was APA. No, it was NRG, okay? So let's say someone said, James, this broke support, and I kind of want to actually do a trade where I think the stock could maybe stay below 95. When you do a short call, okay, or a short call vertical, you're really selling the call where you think the stock could stay below, okay? Now, let's do this trade. We're going to go to the trade tab, and you've already done kind of verticals before. What we're going to do in this case is we're going to go to the 95. And notice the 95 that we're selling, that's where we think the price could stay below. All right, so here we go. Selling the 95, okay, right click there. Notice bid-ask spread, about 10 cents wide, open interest, 1,000. We're going to go sell vertical, okay? Sell the 195, and then what's the 100 for? Well, the 100's for protection. Wonder if it goes to the upside. What gives us the right to buy the shares at 100 and cap the loss? Now, what is the number one reason why people don't buy puts? Well, number one reason, maybe they don't do options. The number two reason is they probably don't want to pay the premium, okay, for the trade. Now, what you're going to notice is we're going to go single order, first triggers SEQ, and we're going to come down here and we're going to buy the 90 put. Now, wait. Do we get a credit or debit here? Okay. Well, if we collect 150 and pay $3, well, we really have a debit there of 150. All right. Now, if we have a right to sell the shares at 90 and there's a debit of 150, what is the break even at expiration? Answer, well, it's going to be about, in this case, a break even of about 88.50. Okay. Now, what I'm going to do is go confirm and send. Okay. And we have a short call vertical. Okay. Plus a long put. And you're going to see that since we're doing it like this, it has an extra commission of 65 cents. And we see that it shows the maximum profit that's only if the stock went all the way to zero. Okay, we're not saying it's going to. Maximum loss built in, which is very nice. Okay, given the vertical and the long put itself, 650. We're going to go ahead and send the order. Now, on this type of trade, could you set a conditional exit that if we broke back above that channel to exit maybe the short call vertical or the long put itself? You sure could. I'm not going to do that because I want to kind of see how this plays out. I want to talk about the fluctuation, okay? So NRG is kind of one of them that's kind of been under pressure, to say the least. Now, I want to also go back to maybe a stock, and I want to go back to just take a quick look at Schlumberger for just a second. And Schlumberger is another one that's kind of crashed again to the downside. Now, I'm going to do 2 trades in 5 minutes, and I want to do the exact replica of what we did with the previous trade. I'm going to go to the trade tab, and what I'm going to do on this is I'm going to come back into where do we think the stock could stay below. Well, old support was about $40, so we're probably thinking the new potential resistance might be $40. Now, what I'm going to do on this is I'm going to right-click on the 40, okay, sell, just like we did before. And then we're going to widen out that strike width to, let's say, $5. Okay? Selling the 40, buying the 45. Now, single order, first triggers SEQ. And now what I'm going to do is I'm going to buy a put below the current price. Now, you could also buy a put where you actually think the stock might go down to as a target price. We're just going to buy a put that has a delta of greater than -30, okay? And so in this case, if we take a look at this, I'm just going to buy this put, bid-ask spread, 3 cents wide, and I'm going to try to buy it about 79 cents. Confirm send, and now what you see on this, you see that this is the exact same thing, just a different example. Short call vertical with a long put. Now let me speak to something I said before, which is, if the stock were to break to the upside, do we have to hurry and get out of that long put? Well, the problem is on this, if the stock shoots to the upside, the most we could lose on the long put is 79 cents. Where's most of the damage going to come from? If someone is going to set a conditional order to exit, they're going to set that conditional order to exit on the short call vertical. That's where the bigger loss is coming from, okay? Note the commission overall, cost of the trade including commission, I should read, send the order. Now, I want to go back to one other one and just kind of talk about a little variation. Now, we know that WBA has been under severe pressure. Its twin cousin with red hair and freckles is CVS, that's typically right across the street. Now, I want to look at this. Some of you said, James, I've never done a vertical, okay? I need to start simple here, okay? So what I want to do is I want to imagine that if we went back and said, where do you wish you would have bought a put? A lot of investors said, James, I wish I would have bought a put right at the 10-period moving average. I wish I would have bought a put right at the 10-period moving average. Wish I would have bought a put at the 10, 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 or near it, at the 10 or near it, and at the 10 or near. So this is the complete opposite of when the stocks are going to the upside. The stock was using the moving average as support. When stocks fall, the moving average can become like that glass ceiling where the stock cannot get above. Now, when we do bearish trades, we don't have to have just short-term outlooks. The last trade that we're going to look at here is, okay, so we did a bearish trade on SLB and NRG. We did a bullish trade on, okay, Visa and also Honeywell. So we did 4 trades so far, 2 bull, 2 bear. Now, I wonder if you said, James, I think that CVS is going to have a very difficult time, okay? And maybe the investor says, I really want to buy a put kind of more at the money, and I want to go farther out in time. Well, why does someone do that? Well, they try to slow down the time decay. They try to have the trend more work in their favor, okay? So what this really is, if you've never done this before, let's practice here. We're going to go to March with 90 plus days to try to have that trend work. And what we're going to do in this case is we're going to buy the put. Now, for some of you advanced people, you might say, well, James, they're going to buy the put and they're going to set the exit if we get above the moving average. Understood, okay? But what we're going to do in this example is we're going to buy the put. And I want you to go out and do this on the paper money account and then watch how does this put gain or lose money, okay? We're going to kind of use this as an example. Now, I don't always show examples of long puts. I'll tell you why next week. But the biggest reason is we're going to practice just buying the put. And you're going to see what the break even is, the max profit if it goes to zero, and the maximum loss is built in. Now, the one thing is, a lot of us, we don't use long puts a lot. I want to be someone that kind of introduces you of how to use long puts as a stock investor, how to use long puts, which you could do a married put, how do you use long puts as a stock investor and collar them, how do you use long puts as a directional trade, whether it's a long put or a long put vertical or a short synthetic. Long puts are used a lot. Welcome to your future. Now, notice here we have the commission as well, cost of trade including the commission. We're going to go ahead and send the order. Now, I'm out of my time here today, okay? But today I wanted to kind of do kind of the collar examples again, practice those again, but then also introduce to you bearish strategies. And I think this is very important when we talk about this because a lot of us kind of feel, well, nervous, okay? Well, what if the markets were to go down? Do you feel prepared? My job as a coach is to make sure you're prepared in any different trend direction, okay? And that's what we want to kind of practice over each one of our classes. Now, remember with what we talked about here today, it was done for example, illustrative purposes only. Barbara Armstrong will be coming up next on getting started with options. So we did 5 trades here today. We'll review those on Thursday. I will see you on the other side tomorrow. Okay. And then, yeah, we'll have good times on Thursday. So, and then also remember that next week we'll have our last class of the year. This has been the Investor Master Series. And thank you, Connie, and thanks to all of you as well. So with that said, have a great day. Take care. Bye-bye.